Right now, as we speak, Astera Labs is trading at exactly $173.32, pushing significantly higher with a gain of $8.13, which translates to a robust 4.92% move to the upside on the intraday session. If you are watching the ticker tape, you are seeing a stock that is currently defying the broader skepticism that often plagues high-valuation semiconductor names, proving that the appetite for infrastructure plays is far from satiated. When you look at a move of nearly 5% in a single trading session, the immediate expectation from the average retail trader is that some massive headline must have just dropped, perhaps a buyout rumor or a surprise earnings pre-announcement. However, the reality is far more subtle and, frankly, more interesting. This movement we are witnessing today is likely a technical breakout combined with a sector-wide realization that the bottleneck in artificial intelligence isn't the GPU itself, but the connection between them. A realization that is finally pricing itself into the daily chart of Astera Labs. Most people looking at this chart on their Robinhood app or through their Fidelity mobile app see a volatile, scary line that zigs and zags with terrifying speed. They expect a stock that is simply riding the coattails of NVIDIA stock, acting as a high-beta proxy that crashes the moment Jensen Huang sneezes. That is the expectation, that Astera is just a baby NVIDIA with a higher risk profile. But the reality is that Astera Labs is decoupling from pure sentiment and trading on a very specific physical necessity that major hyperscalers like Amazon and Microsoft cannot ignore. While Tesla stock or Apple stock often trade on consumer sentiment and brand loyalty, Astera is trading on the laws of physics. The data centers being built right now are hitting a wall, a signal integrity wall, and Astera is effectively the only company selling the latter to get over it. That is why, even on days when the broader market might feel flat, you see these aggressive inflows into A-Lab. It is not just speculation, it is institutional capital waking up to an infrastructure emergency. When we discuss online investment and the tools available to the modern trader, it is easy to get lost in the noise of forums and social media hype. You might be using SoFi Invest or checking your Schwab Intelligent Portfolios to see how your tech exposure is handling the current interest rate environment. But to understand Astera, you have to look at what the smart money is doing in the dark pools. The volume we are seeing today suggests that this isn't just Robinhood stock trading activity from retail enthusiasts chasing a green candle. This has the fingerprints of accumulation. When individual brokerage accounts start chasing a stock, you typically see a spike in the morning followed by a fade. Today, the bid is sustained. This tells us that funds, perhaps those managing Fidelity Wealth Management accounts or large institutional pensions, are stepping in to defend the price at these higher levels, effectively raising the floor. They are looking at the same Interactive Brokers trading charts that you are, but they are interpreting the support levels differently. They see the $160 level not just as a number, but as a line in the sand where the valuation finally makes sense relative to the growth rate. Let's talk about that growth rate and the tension between what the market expects and what the company actually delivers. The expectation is that AI spending will slow down, that the CapEx digestion phase is coming, and stocks like Astera will get crushed when Microsoft or Meta decides to pause spending. That is the bear case you will hear if you browse investing sites or watch cable financial news. However, the reality challenges this view entirely. The reality is that as AI models get larger, they don't just need more GPUs. They need those GPUs to talk to each other faster. If you have 1,000 NVIDIA H100s, but they are connected by slow copper wires that lose signal over a few inches, you have wasted billions of dollars. Astera Labs manufactures the retimers, specifically the Aries PCIe/CXL Smart DSP retimers that act as signal boosters. They allow data to travel longer distances over copper without degrading. This is not a nice-to-have feature. It is an absolute requirement for the servers that are being installed right now. The expectation is that Astera is a chip company. The reality is that they are a physics company solving a signal loss problem that would otherwise render next-generation AI useless. This technical necessity creates a moat that is surprisingly wide. Many investors using Fidelity Investments or looking for investment help often ask why a competitor like Marvell or Broadcom can't just crush Astera. It's a valid question. The expectation is that the giants will eat the small fish. But here is the reality check. Astera Labs built their entire architecture around these specific connectivity standards, PCIe and CXL, from the ground up, while the giants treated it as a side project. By the time the giants realized that connectivity was the main event, Astera had already embedded its Cosmos stack into the hyperscalers' ecosystems. This is crucial. Once a data center manager at AWS or Azure validates Astera's chip and software for their server racks, they are incredibly reluctant to switch. The cost of failure is too high. If an Apple stock investor worries about iPhone sales, they are worrying about consumer preference. If an Astera investor worries, they are worrying about server architecture, which moves much slower and is much stickier than consumer trends. This stickiness is what the market is currently underpricing at $173. If you are currently managing your own capital, perhaps engaging in self-investing through Interactive Brokers, you know the stress of watching a high-volatility stock. Astera Labs is not for the faint of heart. It moves $10 in a heartbeat. You have to understand the mechanics of this volatility. A lot of it comes from the low float and the high short interest that often accumulates in these high-flying names. Short sellers look at the price-to-earnings ratio, which is admittedly high, and they pile in, expecting a valuation reset. This creates a coiled spring. When positive news hits or when technical resistance breaks, like we are seeing today, the shorts are forced to cover, driving the price up disproportionately. This is similar to the mechanics you might see in Robinhood crypto markets, but here it is backed by audited financial statements and massive revenue growth. It creates a scenario where the stock can climb the wall of worry effectively. Now, I want to take a moment to address those of you watching who might be sitting on cash in your Fidelity mutual funds or your Fidelity IRAs, wondering if you missed the boat. The fear of missing out, or FOMO, is dangerous in online investing. You look at the chart, see the massive run-up from the lows, and think it's too late. But let's reframe that. The expectation is that the easy money has been made. The reality might be that the initial run was just the discovery phase where the market realized Astera exists. The next phase is the deployment phase, where the earnings actually catch up to the stock price. We have seen this story before with Tesla stock in roughly 2020 or Nvidia stock in 2016. The stock looks expensive today, but if the company grows revenue at 40 or 50% for the next 3 years, today's price will look cheap in hindsight. Of course, that is a big if, and that is where your risk tolerance comes in. You have to ask yourself if you believe the AI infrastructure build-out is in the first inning or the ninth inning. If you think we're just getting started, then Astera is still early. I want you to pause for a second and engage with this idea. Comment below how many shares of Astera Labs you currently hold, or if you are waiting for a dip to enter. Do you think the volatility is a feature or a bug? I am genuinely curious to see how the retail sentiment stacks up against the institutional flows we are seeing. Moving back to the analysis, we need to discuss the CXL thesis, which is the next major leg of growth for Astera. CXL stands for Compute Express Link. Currently, most of Astera's money comes from PCIe retimers, connecting the GPU to the CPU. But the future is CXL, which allows memory, RAM, to be pooled and shared across different processors. This is the holy grail of data center efficiency. Right now, Fidelity ETFs that track semiconductors are largely weighted towards computing power, the brains, but the bottleneck is shifting to memory. If Astera can successfully lead the CXL transition with their Leo product line, their total addressable market, TAM, expands drastically. The expectation from the street is that CXL is a 2026 story. The reality is that hyperscalers are testing it now. If adoption happens faster than the analysts at Interactive Broker stock trading desks predict, we could see a massive repricing of the stock to the upside. However, we must be responsible and discuss the risks. No script on a stock trading at these multiples is complete without looking at the downside. The biggest risk here is customer concentration. Astera relies heavily on a few massive customers, principally Amazon. If Amazon decides to design their own connectivity chips in-house, Astera takes a massive hit. We have seen Apple do this to its suppliers, and it is a brutal reality of the semiconductor supply chain. When you use investing sites to research stocks, always look at the customer concentration section of the 10K. For Astera, this is the Achilles heel. While they are currently essential, they are operating in a sandbox owned by giants who love to vertically integrate. The counterargument, or the reality to that risk, is that connectivity